Hello, Ann. It's Trent Warner from Union Savings Bank here, emailing this report to you, and I wanted to give you a video to explain kind of what I've done here. What we need to look at are there's two different things here. One of the concerns we had when we were speaking on the phone was here's your current first mortgage, 72,000 with the 28,000 and change second. Payments off a little bit, but it'll work for the calculations. Everything is paid off in 18 years. So you're going to see right down here, everything's figured on 18 years. So you're not backing up. So we're staying away from that interest thing. Okay. Here's your current situation as it runs down through here. The way you look at this is first and second mortgage, which that's what you have right now. 3 years from now, 3 month or 36-month analysis gives you an idea of what you've invested some money to do your refinance, what makes sense. This is a 15-year projection. That's an 18-year projection, so you know exactly where you stand. So at 15 years, you can be able to tell what your home value is, and so on and so forth. It'll run through here. What we need to do first is look at your current situation compared to one of the things that we talked about, where if we went to a fixed rate on our current amount owed, what would that cost me backing up additional interest, so on and so forth. So what this first scenario is, let's compare this first column with this last column, fixed apples. Um, Here's your existing scenario, which you understand all that. Here was what we put both of these loans together, 72,000 and 28 and change. We had a $100,000 loan, 5.5% interest which is the rate for a 30 year. It would go down if we went to 15. 18 years amortization. Payment would be $730 versus your $644, but that's fixed. It's never going to go above that. So you're about $146 difference between those. Well, it's 100 and what? No, 90, $86 difference between these two. So you'd pay $86 additional. Your difference would be about 3,000, a little over 3,100 bucks, because you take this current total payments to here. This would be your difference in principal. You would actually put more principal in on the fixed rate versus the adjustable, because of the way the amortization tables work and the way things are set up. Because what I've done is, let's back up to this current scenario. What I did is I said it was a 30-year loan that was run, and that it just plugs it in where you are in your payment schedule with 18 years left, and just runs the numbers out to get to this payoff. Okay. So actually, you're going to put a little bit more principal in the property if you go to the fixed rate. Um, so that just runs your scenario apples to apples. Okay. The big thing is we need $20,000 additional to do improvements on the home. So what I've done is I've run an 18-year fixed and ran that out to tell you what the costs are, what your total investment would be, and still paying it off in 18 years. So these are your numbers on how that works. What I've also done is I have plugged it in at 2.99 convertible rate, which what that means is you'd have a 299. It'd be the same mortgage that you have right here, but it'd be all in one. It'd be an adjustable rate, which adjusts every 12 months. 2% is the maximum it can adjust to, so it could go to 499 next year. 6% maximum on the top end, so the maximum this could go to is 8.99% over the life of the loan. So that would be your worst case scenario. But what this does is you would stay with a 299 1 year ARM until you get to a point where you thought that ARM was not advantageous for you, and then you convert that loan over to a fixed rate. All that is a phone call to us. You call us and tell us you want to convert over. It takes about a week and a half, 2 weeks. We lock you in at the rate, and you're converted over to a fixed product, which would be over here. So what they would do is they would put you on the whatever years are left in that fixed product. So you could fix that loan amount down. But what you would be doing with the additional funds, with the additional $20,000, your payment would be $719 on the principal and interest. That's pretty much just runs through all the numbers for you and gives you an idea of where you're at. So the 299 would put you ahead on a short-term basis and get your money out. Your payment would be under $1,000. I think that's where you want it to be, and you'd be able to take advantage of the interest rates. So if you have any questions, give me a ring, 513-842-4590. Thanks. Make it a great day, and I'll speak to you soon.